Hi everyone, welcome to Chapter 1 for your TX course under FA 23. In this particular chapter, we're going to introduce the UK tax system. This is part 1 of 3, and indeed this particular chapter, as you'll see me mention a little bit later on, is quite manageable. A lot of rote learning to do, but nothing overly technical. I would favour this particular chapter certainly as a base for short form questions. Okay, so just take it bite-sized chunks in terms of the video and indeed the chapter itself within the study hub. So let's kick off and look at this first area. So first area is really the scope. So the scope of the syllabus. Let's talk firstly about tax itself, or the purpose of taxation. Now I know there's a lot of information here for you. Now in terms of using tax or using taxation, clearly taxation funds government expenditure. Outside of that, it's a tool in itself. In other words, we can influence, or governments can influence demand by perhaps increasing or indeed reducing tax. Outside of that, the UK tax system, like many other jurisdictions, sort of encourages and discourages some things. First thing is really the area of sort of saving and pension provision. What do I mean by that? Well, in essence, under the UK tax system, you'll get benefits or tax breaks, if you will, by actually investing for your retirement. Tax incentives, let's say. Outside of that, certainly giving to charity is incentivized. And indeed, outside of that, certainly being an entrepreneur, or indeed investing in particular areas. In terms of what it may discourage, clearly things like smoking, drinking, etc., or at least that's what they tell us, and certainly motoring by imposing fuel duties. So in terms of the system itself, it's used to fund a variety of things, not least government expenditure, and indeed it's designed to encourage and indeed discourage some areas. Let's be familiar here with this distinction between what a direct tax is and indeed what an indirect tax is. Now, direct taxes, as it says on the tin, as it were, are levied on things like income, chargeable gains, and capital transfers. So in effect, we're talking about, the main tax heads, certainly within our syllabus, along with national insurance. So in essence, these areas of tax are sort of collected, these direct tax areas are collected by HMRC to in effect fund the areas that we saw above. Outside of that, what do we mean by indirect? Well, by indirect, we mean applied to spending. Okay, so the classic one, obviously, is VAT, or value added tax. In effect, these registered VAT suppliers or registered VAT businesses are sort of unpaid collectors. They collect it from customers by charging VAT and have to hand it over, in effect, every quarter. So in terms of a summary there, some taxes are direct, in the main, most of them, and one main indirect tax in terms of VAT. Another distinction that's important here is capital versus revenue taxes. This is the easier one, I guess, because when we think about income and indeed gains, etc., certainly revenue taxes are, these areas that pertain to people's earnings, okay, self-employed individuals, let's say a plumber, or perhaps someone offering services, an accountant, a tax advisor, etc. Those are revenue taxes, taxes on incomes and profits. Now, capital tax is slightly different. We're talking about taxes on assets, owned rather than earned. So, classic example, obviously, is capital gains tax and indeed inheritance tax. Okay? So there's a sort of a quick intro to the purposes of taxation and really some definitions. Now, in terms of relevant taxes, there are a number in our syllabus, as we know. First one, and indeed the biggest area of the TX syllabus for us, is income tax. So, a liability to UK income tax arises in several cases. If the income is within UK territory, certainly, and indeed outside of that, if the income is outside of the UK, but the person is resident in the UK for tax purposes. So note the difference there. When we say arising within the territory, I'm talking about someone who runs a business in London or perhaps Glasgow, etc. Whereas here, the focus is on, well, where are they resident? If they're resident in the UK, but they derive income from a business in Johannesburg, well, so be it. They're going to be taxed on it because they're resident. So that's income tax on a basic level. Capital gains tax, as you would imagine, is really a tax on gains. So a liability is established if the gain is inside or outside the UK and the taxpayer is resident. So when I say gain, I have an asset, let's say an investment property in London or even in Paris. I'm UK resident. I sell it. I make a gain. CGT will be payable. Okay. Now, in terms of inheritance tax, as mentioned, this, along with capital gains tax, is a capital tax. It's a tax on assets. So when is that liability established? Well, if there's a transfer of property located inside the UK or, note, outside the UK, if the transferor is domiciled as a permanent home in the UK. Now, don't worry too much about the definition of domicile. There's several areas to domicile. But for our purposes, let's just say, and I don't think that written questions on IHT in this particular area are common at all. But let's just say if the individual is domiciled, it's a similar concept in one sense to residency, although some slight twists. Okay. Next one for us is corporation tax, which, as you'd expect, is going to be chargeable on a corporation if the company has income or gains within the territory of the UK or income gains arising outside the UK, and the company is entitled to the income gain is resident in the UK for tax purposes. So if they're resident, in other words, incorporated, or centrally managed and controlled within the UK, then bingo, you're going to be taxed on your worldwide income. What about the last one for us, VAT? Now remember, this is an indirect tax. All the others are direct taxes on income gains, etc. So in terms of VAT, really, that liability or potential liability arises in relation to a taxable supply if the place of supply, is in the UK. Okay, the place of supply, where that, in effect, good was sold. So we've talked about the 5 tax heads. We talked about the sort of background or purposes, if you will, to the area of UK taxation. What about personal tax years? Well, certainly income tax, CGT and NIC for individuals, sole traders and partnerships assessed on our tax year, which is 6th of April to the 5th of April, bar none. In terms of IHT, IHT is assessed and indeed calculated when a chargeable lifetime gift is made or when a person dies. Now, for our purposes right now, and this is early in the course, just take it that a chargeable lifetime gift is basically a gift in lifetime, okay? But the tax year 6th of April, 5th of April is relevant to the application of certain exemptions and identifying some when some tax is payable. So in essence, in terms of the IHT tax banner, the tax year is actually split into 2. More of that when we get to the IHT area. So that's the tax year for personal taxes. Broadly speaking, the 6th of April in the year to the 5th of April in the following year. What about companies or accounting periods for corporation tax? Okay, well, broadly speaking, companies are charged a corporation tax in relation to a chargeable accounting period. Now, very often, but not always, that's just the period of account. In other words, a company makes up accounts every year to the 31st of December. That's their chargeable accounting period, okay? But note that the period can never exceed 12 months, and as I've just mentioned, usually the same as the period to which it prepares annual accounts. For VAT, normally it's a quarter, In other words, a 3-month period, let's say the VAT registered supplier simply calculates the difference between output or sales VAT and input or purchase VAT, and the difference will be paid over following the 3-month VAT quarter. Okay, so that concludes part 1. I hope that you enjoyed my delivery of that and that it made some sense. As mentioned in the introduction, we'll start slowly, but let's get sort of pumping as we get into chapters 2, 3, 4, when we're going to be dealing with computations. We're going to be dealing with these little rules and these nuances. And remember, as always, that the key to learning tax, certainly in my experience, is simply to practice. Okay, thanks for listening.